We're jumping straight into AES today. Everyone is watching the price action, but the real story is the massive pivot toward data centers and the renewable energy backlog.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds, do us a huge favor, hit that subscribe button and smash the like.
It really helps us out.
It does. Our mission here is simple. We want to help you separate the signal from the noise without drowning you in Wall Street jargon. We do the reading so you don't have to.
So let's set the stage here because it's a weird one. AES is technically a utility company.
Right.
And usually when we talk about utilities on this show, we are talking about, widows and orphans stocks, slow, steady, low volatility.
Practically watching paint dry.
Exactly. But you opened by linking this to data centers and a massive pivot. Why is the market suddenly treating a legacy power company like it's a high-growth tech stock?
That is the billion-dollar question, isn't it? If you look at the chart, this thing is acting very, well, unutility-like.
Yeah, the momentum is pretty wild.
The stock is up roughly 28% over the last 6 months. Just last week, we saw an 8% pop. It has serious momentum.
And it creates this real conflict.
It really does. You have one camp arguing this is a diamond in the rough, incredibly undervalued at a price-to-earnings ratio of around 9 to 11 times.
Which is cheap for any growth story.
But then you have the critics, and they are loud screaming that it's a debt-heavy trap just waiting to implode.
It's a polarized trade, for sure.
Yeah.
But let's dig into that growth narrative first. Why is money piling into AES specifically, rather than, say, a Duke Energy or a Southern company?
2 words. Artificial intelligence.
Okay.
Or, to be more precise, the physical infrastructure required to keep AI alive. We are in a new gold rush, right? Everyone knows that.
Sure, the chip makers.
But the market is realizing that you can't just buy the pickaxes, the NVIDIA chips. You need the electricity to run them. The power demand from AI and data centers is it's skyrocketing, and the grid is the bottleneck.
And AES is positioning itself right in the middle of that.
Right in the middle of that bottleneck.
Okay, but let's pause and separate the hype from the reality here. Every utility CEO is going on TV right now claiming they are an AI play.
Right.
Is AES actually doing it, or are they just slapping an AI sticker on a coal plant?
No, this is real ink on paper. This isn't just a press release. They have signed power purchase agreements, PPAs, specifically for data centers.
Okay.
We're talking about 1.6 gigawatts worth of power dedicated just to that sector.
Wow. And just to put that in perspective for everyone, 1.6 gigawatts is roughly enough to power over 1 million homes.
But it's all being funneled directly into these hyperscale data centers.
That's a massive amount of juice.
Yeah.
And for the listener who might hear PPA and tune out, let's clarify why that acronym is the magic word here.
Yeah, this is important.
A power purchase agreement is effectively a long-term contract. It means the revenue is guaranteed for a set period, usually 10 to 20 years.
Right. It's not like they are generating power and hoping someone buys it on the spot market where prices fluctuate every hour.
Exactly. It turns a volatile commodity business into a fixed income stream. It's locked-in cash flow.
So when Amazon or Google signs a PPA with AES, they are guaranteeing that revenue for a decade or more.
That is why the valuation starts to look different than a standard utility.
And that 1.6 gigawatts is just the tip of the iceberg. The real moat around this company, the thing that protects them from competition, is their massive backlog.
Right.
They have an 11.1 gigawatt backlog of signed projects. That is a huge pipeline of future growth just waiting to be built and turned on.
And what's fascinating to me is the composition of that backlog. I mean, 10 years ago, AES was a dirty word in ESG circles. They were heavy on coal.
Oh, yeah.
But if you look at their generation mix now, over 53% is renewables. They're aggressively moving away from fossil fuels.
And fast. They have a plan to exit coal completely by 2025.
Which is basically tomorrow. That is an incredibly fast transition for a company of this size.
It is.
And I want to emphasize that this isn't just about being green or, saving the polar bears. From a cold, hard investment standpoint, this de-risks their cash flow.
How so?
Well, fossil fuel prices, natural gas, coal, oil, they're volatile. They spike when there's a war. They crash when there's a surplus. The sun and wind.
They're free.
They are free. So by locking in these renewable contracts, they stabilize their operating costs.
Right.
Plus, it aligns them with global decarbonization goals, which keeps the regulators off their backs.
It's essentially removing the biggest variable from their balance sheet, the cost of goods sold.
Precisely.
Yeah.
You build the solar farm once. and the input cost sunlight is zero forever.
So you've got the growth story with AI and renewables, but let's not forget, at its core, this is still a utility.
Mm-hmm.
And utility investors are a specific breed. They want to get paid while they wait. AES delivers there too. We're looking at a solid dividend yield sitting right around 4.7 to 5%.
And consistency matters. They've raised that dividend for 13 years straight.
13 years.
That shows a serious commitment to returning capital to shareholders. It's not a tech stock that hoards all its cash. They are actually paying you to hold the risk.
Right. And management isn't just sitting on their hands collecting rent. They are targeting 5 to 7% annualized growth through 2027.
And their margins are looking really healthy too.
Yeah, the EBITDA margins are nearly 29%.
Hold on, let's define that for the non-accountants. EBITDA earnings before interest, taxes, depreciation, and amortization is basically a measure of raw operating profitability.
Right, the pure profit.
And 29% is healthy. It shows that as they stop burning expensive coal and start spinning wind turbines, the cost of generating that power drops and the profit margin widens.
Okay, but we have to address the elephant in the room regarding that recent 8% pop in the stock price. It wasn't just about earnings or dividends. The rumor mill is spinning faster than their turbines right now.
Oh, the chatter is deafening.
It really is. And I want to stress, this is unconfirmed, but reports are suggesting that some massive players are circling.
Big names.
We're hearing names like BlackRock's Global Infrastructure Partners and EQT potentially exploring a buyout.
But that would be a seismic deal in the energy space.
Huge. And that speculation is definitely driving some of that recent surge. If you're an investor, the idea of a premium buyout offer is tantalizing.
It adds a layer of speculative upside.
Totally. You're not just buying a utility. You're buying a lottery ticket that BlackRock might pay a 30% premium to take it private.
It makes sense why private equity would want it. Infrastructure is an inflation hedge. If you own the power lines and the generation for the AI boom, you own a very valuable asset class.
What?
And this is a big but. We have to look at the flip side. We've painted a very sunny picture here. AI growth, renewable backlog, dividends, takeover targets. This isn't a risk-free trade.
Not at all. In fact, when you peel back the layers, things get a little scary.
Yeah, the biggest red flag on the balance sheet is the debt. It is ugly.
Yeah.
We are talking about long-term debt exceeding $26 billion.
26 billion with a B. That is a massive number, especially when you consider their market cap is only around 13 or 14 billion.
Exactly. They have roughly twice as much debt as they have equity value. Their leverage ratio is sitting at 13.1.
And that's high.
It's very high. In a low interest rate world like we had in 2020, companies could get away with that. Money was free. But we are still in a relatively higher rate environment. Servicing that debt becomes expensive.
It's like having a massive mortgage on a rental property. Sure, the rent checks are coming in, but if your mortgage payment is taking up 80% of the rent,
You don't have much room for error.
none. If a tenant leaves or the roof leaks, you're in trouble.
That's the perfect analogy. And it limits their flexibility. If a new opportunity comes up or if they hit a snag, they don't have a massive war chest of cash to
You're
fix it.
right.
They have to service that debt first.
And speaking of hitting a snag,
Yeah.
we have to talk about Panama.
Yes, the Panama headache. This is the kind of thing that keeps general counsels awake at night.
So what's the deal there?
AES is facing a $4 billion antitrust lawsuit in Panama regarding their conduct with liquid natural gas, or LNG.
4 billion. Let's put that in context. We just said the company's worth maybe 14 billion.
So a $4 billion judgment is essentially wiping out 30% of the company's value overnight if it goes the wrong way.
Even if the market has priced in some of that risk, meaning the stock is cheaper because people know about the lawsuit, that is a dark cloud hanging over the stock.
It's a huge cloud because legal outcomes are binary. If a judge rules against them, that could be catastrophic for the share price in the short term.
It's not just a fine, it's a material hit to the balance sheet.
Right, it creates massive uncertainty. And markets hate uncertainty more than they hate bad news.
And there's another pressure point.
Yes, capital expenditure or CapEx. We talked about that 11 gigawatt backlog like it's a pure positive, but you have to pay to build that stuff.
Well, exactly. You can't build wind farms and solar arrays for free.
So CapEx is up about 11%. They are spending heavily to grow, and this creates a cash crunch.
Right.
They are burning cash to build these new plants while simultaneously trying to pay that generous dividend we praised earlier. Free cash flow is being squeezed from both ends.
It's a classic borrowing from the future to build the future scenario. They are betting that once these projects turn on, the cash will flood in and cover the debts.
But in the meantime, they're walking a tightrope.
And that tension is why we've seen some negative sentiment from analysts recently. Barclays actually downgraded the stock on February 4th.
And their concern was exactly what we just described. The high debt load combined with the sheer cost of their growth plans.
You're asking, is the growth worth the cost of the credit card bill?
Basically, yeah. And let's be honest, not every bet pays off. Management isn't infallible.
Right, they had that green hydrogen project that was recently canceled.
That was a big disappointment for a lot of people.
It was. It's a reminder that pivoting a massive legacy utility company into a futuristic green energy giant is messy. It's not a straight line.
Right.
Not every project is a winner, and execution risk is real. That cancellation shows they are willing to cut losses, which is good discipline.
But it also highlights that the path to 2027 is bumpy. It also signals that the green revolution isn't just about throwing money at a wall and seeing what sticks.
That's a great point.
Hydrogen is tricky. And pulling the plug tells me management is at least being realistic about what is profitable versus what is just a science experiment.
So we've laid out the battlefield. You have the bull case growth, AI, dividends. You have the bear case debt, lawsuits, cash burn.
A lot to weigh.
For the listener holding this stock or thinking about buying it, let's get practical. What do we need to watch in the immediate future? What are the triggers?
Well, we are right in the thick of it. Earnings season is here. The fourth quarter and full year 2025 reports are imminent.
And here is the key. Don't get too hung up on the headline number for the last quarter. Consensus is expecting an earnings per share, or EPS, of roughly $2.18.
But honestly, that's looking in the rearview mirror. The stock moves on the future.
Exactly. If they hit $2.15 or $2.20, it doesn't really change the thesis much.
So what's the signal?
The signal is the guidance. The key will be whether they reaffirm their 2026 outlook and that 5 to 7% growth target.
That's everything. If they come out and say, hey, interest rates are hurting us, we need to lower our growth target to 3%, the stock could tumble.
Because the current stock price is pricing in that 5 to 7% growth. If the growth story cracks, the valuation multiple compresses.
And the market will stop treating them like a growth stock and send them back to the boring utility valuation basement.
Precisely. Also, for the income investors, pay attention this week, the week of February 8th. Dividend X dates and updates are happening now.
Good call. If you're in this for the yield, you need to be aware of those dates to capture the payout. You don't want to buy the day after the ex-dividend date and miss the check.
And obviously, we're keeping one eye on the newswire for those buyout rumors. If BlackRock or EQT makes a formal move, the fundamentals almost go out the window in the short term.
It becomes an arbitrage play at that point.
There is also the macro environment to consider. We can't analyze this in a vacuum. Interest rates are the invisible hand here.
Absolutely.
If we see the Federal Reserve cut interest rates, utilities like AES usually benefit disproportionately.
Redo.
Why is that? Break that correlation down for us simply.
It's twofold. First, utility stocks are often seen as bond proxies. When bond yields fall, investors look for yield elsewhere, and they flock to utilities paying 5%.
It's a competition for income.
Right. If a treasury bond only pays 3%, that 5% from AES looks a lot juicier. So demand for the stock goes up.
Okay, that makes sense.
But secondly, and more importantly for AES specifically, remember that $26 billion debt pile.
Hard to forget.
Most of that debt has interest attached to it. When that debt matures, they have to refinance it. In a high-rate environment, refinancing is expensive. But if rates drop, the cost of servicing that massive debt load goes down. A 1% drop in rates could save them tens or hundreds of millions in interest expenses over time.
So a rate-cutting cycle is a massive tailwind for AES. It hits the bottom line directly.
Exactly. So if you are bullish on rates coming down, you should probably be looking at utilities like this. It's a macro play as much as it is a company play.
Okay, let's unpack this and bring it all home. What does this all mean for the listener? How should they be thinking about this ticker?
I think it comes down to your risk tolerance and your belief in the energy transition. You are looking at a company that is essentially a derivative play on the AI boom. If you believe data centers will continue to consume massive amounts of power and that the grid needs to get greener to support that, AES is one of the best positioned utilities to serve that demand. They have the contracts, they have the land, they have the backlog.
But you have to be willing to stomach the baggage. You are inheriting a massive debt pile that would make a Dave Ramsey fan faint.
That's one way to put it.
And you have a potentially explosive lawsuit in Panama hanging over your head.
That's the trade-off. It's high reward potential with very specific identifiable risks. It's not a set it and forget it stock like a Coca-Cola might be. You have to watch the news. You have to watch the Panama headlines.
Here's where it gets really interesting for me, and I want to leave you with this thought. We talked about the buyout rumors. Think about the debt.
Okay, what about it?
If the buyout rumors are true and a giant like BlackRock steps in, that $26 billion in debt, that becomes someone else's problem. The shareholders get bought out at a premium, they win big, and the acquirer deals with the leverage. It's the perfect exit.
That is the dream scenario for the bulls. The cavalry arrives and pays off the mortgage.
But if the rumors are false, if no white knight comes riding in with a checkbook, you have to ask yourself a very serious question.
What's that?
Can their renewable growth outrun their interest payments?
That is the ultimate race they are running. Can they build enough profitable solar and wind projects fast enough to generate the cash needed to service that mountain of debt?
That's the lowdown on AES. It's a fascinating setup, whether you're a value hunter or a growth chaser. Don't forget to subscribe if you want to stay ahead of the next move. We'll catch you on the next one.